Welcome to Wealth Unfiltered, your go-to source for industry insights and wealth creation. Stay ahead of the curve with a thorough breakdown of market trends, financial developments, and the impact of current events on your wealth building strategy. We deliver the latest updates and essential insights into the financial world through expert interviews and detailed analysis. Hi there, welcome back to Wealth Unfiltered, our newest episode. Today's episode is going to be on building a better portfolio. So we're going to focus on factors today like passive versus active investments, risk tolerance, asset allocation, and so much more. My name is Samantha Parrinello. I am the host of the show, and I am here today with my husband and resident guest and expert, Chris Parrinello. Welcome.
Thank you. Yeah, thanks for joining us tonight.
Yeah. So just like on the last episode, we're going to get started today with Chris's hot take. So take it away.
Yeah, so my hot take today is going to revolve around risk, which, is a four-letter word. People try to avoid risk at all costs. But the tricky thing about risk is in order to get solid returns, you have to feel comfortable with risk. You have to be able to manipulate risk and build in risk-adjusted returns. And risk can actually be your friend if you can mitigate it well enough to get the returns that you're looking for your portfolio.
Awesome. Thank you. Okay, so just like the last episode, I wrote down some questions that I'd like to ask you that I feel like our investors have asked us a lot, and as well as our listeners might be interested in knowing. So the first thing I'd like to ask and to cover would be, what is the difference between active and passive investments? And also, do you use both?
Yeah, absolutely. And I do. I think, when you think of active investments, you can classify that as owning a business. It could be buying real estate that you're personally going to manage, or hiring a property management company to manage for you is quasi-active. You could consider your W-2 job an active investment. You're investing your time and you're getting paid. You can use those funds for investing in things more passively. Passive investments are going to be more of, you're looking for some time freedom, and you want to take some of the money that you've made actively, put that to work for you to where you're not having to spend extra time managing that outside of doing due diligence and finding solid investments for you to place your money.
Yeah, we like to call them income without effort.
Yeah, exactly. Exactly. You want to have the key to a strong, diversified portfolio, whether it's active, passive, both, is having multiple income streams. So if you can build a scenario where you can make your money work for you, eventually you'll get to a point to where you're getting to work by choice and not by need.
Right. Which I think is the dream, right?
100%.
So as we're talking about building a portfolio, let's go to the very start. So for people who are looking to start or maybe have just recently started, what are some of the most common mistakes people make when they're starting their investment journey?
I would say a lot of it revolves around not doing enough research. So a lot of times what ends up happening is you grow up, our education system in America doesn't really teach you about investing. So if you have parents that really understand investing, you might learn that way, or you might do your own research. I think that the way it typically manifests is you get your first job, and when you get to a job that offers a 401k or something like that, you start getting some kind of employee match. You kind of build it, but your money goes into this 401k, and it's kind of stuck in traditional equities. In addition to that, I think what I would suggest most people do is to just decide a certain fraction of what they make.
Okay.
Outside of the 401k, like do the 401k, especially if you get an employee match, because you're going to get essentially free money added on to what you're allocating. And a lot of that's growing tax-free. That's a win. If you can afford and you can, have some willpower and put a portion of your money away, 10, 20, 30%, depending on what you need for your own, survival and happiness. Start building a portfolio and doing research on different things that interest you. So whether it's stocks, whether it's bonds, there's usually a time and a place where things are more attractive. And usually it's when some area is facing some level of adversity. That's usually the time that you can jump in and get things at a really great basis. As you're constructing that portfolio, you want to make sure that the correlation to the different things you're diversifying in, kind of when one is doing really well, the other one might not be doing as well. And then it shifts. So you build and you kind of build an equilibrium to where you're basically hedging against risk.
Yeah, I love that. I think one of the things that you just mentioned that I think is probably something that you had growing up that I didn't, because your parents were much older when they had you. And I think a lot of times what ends up happening is that people like me who had really young parents, my mom was she was in her early 20s. So as I was growing up, she wasn't in the part of her life where she was starting her investment journey. She was still earning the money to put into something like that. And she wasn't actively investing, whereas your family had already been actively investing since you're the youngest of so many. So I find it interesting the dichotomy of like the two of us and how growing up, even though we do have a lot of similarities, just that one aspect has really shaped your investment knowledge and giving you like a foundation for investments that I didn't have until I was much older. And, my mom, she's invested in a lot of the Viking deals, but I would say her journey just started so much later. So I wasn't learning from her as much as I was learning like through you and through our jobs, really, and I think that we're pretty excited and fortunate that we get to offer that to our daughter now. She's really young and being able to teach her about investments. But a lot of people, I don't think, at least from what I know, is when you have parents as young as I did, like you don't have that exposure.
Yeah. And I remember going back to the early 90s when that was about when I was starting to learn. And the reason I was starting to learn was because my dad was starting to learn. So it was a similar thing that you mentioned about your mom. He had just retired and he was going on a fixed income. He realized that inflation was going to cause prices to go up, but his pension, he worked for the DOD, his pension in retirement was going to stay the same. There'd be a COLA, but it wasn't going to grow significantly. So in order for him to keep his quality of life, he knew he had to start educating himself on investing, and he fell in love with it. And after finding success, he became kind of the person that would teach all of the different family members like how to evaluate where to put their money. And part of that learning was for me. I remember my first lesson at 7 or 8 years old, about Ella's age, which she's like about that age where we're going to start teaching her, was the miracle of compound interest. So
I was just going to say the thing that I love is that we're teaching her that like, even though saving's okay, investing's better.
Right, exactly. It's like when, like, I remember as a child, like the way that my dad made it interesting for me, he was like, wouldn't it be nice if you had a money tree and every day you could go to that money tree and a new dollar bill would grow as a leaf and you could pluck that dollar off and the next day there'd be another dollar. And I was like, yeah, like what a great dream. Like that would be amazing. This would be magic. But then he explained to me that that's what investing is.
Right.
That if you create an investment strategy, there's going to be times when it doesn't yield as much money, but you're essentially going to put your money somewhere. And if you're smart about it, it's going to yield you more money. And if you do this over time, eventually you'll get to a point where you're massively reducing your risk because of how diversified the different money trees that you have that are growing money based off of performance.
I love that. So I'm going to skip my next question. We'll go back to it, but you're talking about diversification. So I think it's really important to touch like how important do you feel diversification and asset allocation is to building a strong portfolio?
Hugely. The thing is, the root importance of diversification is to mitigate risk. So if you have all of your money in one thing and that thing is doing really well for a long time, but then something comes and disrupts that thing's ability to perform, if that's the only thing you're invested in, that could be really painful.
Absolutely.
But if you have money in stocks, and there's going to be times where the stock market is just on a roar, there's going to be times where there's a correction. That's usually traditional investing is in traditional equities or stocks and bonds. And they usually correlate in a way to where bonds are going to perform in times where people are more fearful because people are going to put their money in bonds because that is, in many cases, what people consider a risk-free asset. The U.S. government has never defaulted on a treasury bond. So it's about as close as risk-free as you can get. You're also going to get a very small return. A lot of times, if you look at treasury yields today, you're looking at 4%, that type of range. When people are fearful, they'll put their money there. They know that they can count on that 4%. It's almost guaranteed. When people see the economy doing really well and they start looking at certain companies, especially with the tech boom, you bought Tesla at $17 a share, you see where it's gone through the splits, you've made a killing. So if you had all of your money in Tesla, you probably made a ton of money, but you were exposed if something went wrong with that one company.
Would you say right now that you're seeing on media and just like what's being tracked in the markets, would you consider right now a bullish or bearish market? Or
I would say since the election, people are very bullish. But I think that with everything that happened through COVID, like there has been kind of a pullback and a small correction. I don't think it's over. When you look at root causes of why you have a run and why you have a strong economy, it usually has to do with a lot of the things that Trump campaigned on. Deregulation, tax cuts. A lot of this goes back to what we talked about in the last episode. It's human nature. So if people have more money, people will spend more money. If people spend more money, then the economy looks very strong. When people become fearful and they start putting their money in bonds and they instead of spending 70% of their income, they're spending 50% of their income, 30% of their income, and everyone's spending less money, the economy will compress. And you won't make as much in hyper growth type markets like the stock market.
Yeah, I know we're going to cover a lot more in depth about that. We're going to talk about that in probably the next week or two in a future episode about buying power and how it affects the markets. But I think going back to what you talked about for your hot take, one of the things that I think it's a really important piece to focus on when people are starting their investment journey is understanding their risk tolerance. So I would say, what tips would you give people to help them determine theirs?
Yeah, I would look at it as kind of net worth, how well your portfolio is diversified, and really how quickly you're going to need to be able to liquidate those funds. How much liquidity do you need? And then also the second piece to that liquidity question is, are you relying on the yield from those investments to survive, like cash flow?
So the other piece, I feel like risk tolerance and risk appetite, I feel like are very important pieces. Like some people, I feel like probably don't know the difference. So I know like with a risk appetite, that's where people are maybe more willing to do stocks because they're more excited about the upside than they are nervous about the loss or potential loss.
Yeah. And this is why they created kind of ETFs and the idea where you could put $1 across the entire market.
You're going to need to explain ETFs to those of us like me who don't know.
Yeah, it's just buying a share of a broader market to where if the market goes up, you win. It's sort of like if you're playing the entire board.
Like roulette.
Like roulette. You're putting lots of chips across. You put $1 on all of the red. Every time it goes red, or you put a lot of money on red. If it goes red, you win. If it goes black, you lose. An ETF, you're basically saying, I'm betting that the market's going to go up. And typically, over time, the market will go up.
Okay.
Because the market's inflationary, things will get overvalued. There'll be more money in the system. But there's a lot of other aspects of investing that don't revolve around the stock market. And I think that that's one of the things that as investors become more sophisticated, they tend to look at alternative markets like real estate and realize that there's a reason why almost all of the uber wealthy people in the world got there by utilizing real estate as an asset class.
Yeah, I have to say, because, I do the social media. And one of the things that during our research, I was shocked to find out are people like Taylor Swift, who apparently has a giant real estate portfolio. And I had no idea. Beyonce and Jay-Z, huge real estate portfolio. Arnold Schwarzenegger, huge portfolio.
Yeah.
Like I'm looking at all these people and I'm like, dang, like, them for being singers, actresses, actors, performers, entertainers. But then you look at, they're actually very strategic business people who are taking the earnings from the thing that their passion they love, and they're creating like big time wealth using, other asset classes like real estate.
And the argument I would make is I bet you that most of those celebrities, when they started making money, had a really savvy financial advisor that helped them build a diversification strategy where they said, you're making this immense amount of money. If you strategically buy real estate, it's going to protect you and help you grow your wealth long term.
But I think that's brilliant.
Yeah,
I think that's what we're telling everybody.
I agree. And I think that's going back to the active and passive strategies. When I talk to our most successful investors, the ones that are the most successful and have the most wealth tend to be people that have an incredible active strategy. And why they're working with Viking is they're trying to utilize the money they've amassed to buy back their freedom. They don't want to spend the time on their active portfolio. And that active portfolio, if I had to pick the two areas, it's people that own their own companies and maybe have gotten to a point where they're selling. So
Right.
you spent 20, 30 years building this company or less, and you've just had a company that's grown very quickly. You sell it, you have this huge windfall of money. And usually what brings them to a real estate company is they're trying to figure out a tax arbitrage strategy. But they're also trying to find a way to help multiply their money and grow their money to where they can not have to be reliant on owning a company anymore, or something like that.
Time freedom.
The other really successful avatar that I've seen are the people that understand real estate as well as we do, but they've been buying small single family homes or 10-unit multifamily properties, and they've built 200, 300, 400 units, and they've been managing it with a group of small property managers. And for them, they've understand the power of having real estate professional status.
Oh, right.
And now they're like, well, I have all of this cash flow coming in from my active real estate. I can invest with you, take these large passive losses that were brought around in the 2017 Trump tax cuts and offset a huge amount of my income. And a lot of these people will own commercial real estate, like retail strip malls, gas stations, things like that.
Well, in our specific avatar, own a lot of emergency clinics and
urgent care, things like that. It's hugely powerful when you can combine an incredibly powerful active strategy and then buy your time back with a passive strategy where you're never going to make as much passively as you would actively, because you're not also being compensated for your sweat equity.
Right.
But when you get to a point where you want to not put in the sweat equity, being able to find a sponsor that you trust or put your money to work for you in other avenues where you're not so focused on managing the day-to-day gives you the freedom to spend time with your family, to go on trips and travel, or to do hobbies that you really love to do.
So just before I go to our next question, touching on that and your expert advice, I think you're an expert definitely in real estate and passive investing. What type of diversification do you think, if you think, is there a best scenario for like percentage? Is it 50-50? Is it 60-40? Like, what do you think?
I would say I would lean, 60-40 and also
passive?
I would say it's also where you are in your life. So if you're in your 30s and you love real estate and you want to build a real estate empire, you want to own 50 units, 100 units, whatever it is, and you don't mind doing the work, then yeah, I think, probably in the lower age range, it's 80-20.
And you're referring to active now, right?
Active to passive.
Okay.
And then as you start churning a bunch of income and you multiply, where you start transitioning into a higher percentage of passive is when you want to do less of the work.
I think also when you're just on like the generating of the income and wealth, like you were kind of like you were saying, like I know people who are, I'm planning to get married and I'm planning to do this and I'm planning to, so you're like setting your life up still versus somebody who says, I'm retiring and I want to enjoy traveling and I want to do these things. So like you're saying, the part of your personal life cycle where you are also the personal side on top of the professional side.
Yeah. And I mean, it's also, especially if you're talking about real estate, in many facets, real estate's hard. What Viking does, it's not any one person couldn't just decide that they're going to do that one day and everyone's going to be successful. It's hard to find good deals. It's hard to build a model that successfully forecasts. It's hard to structure debt and have the relationships with brokers. It is very hard to operate at this level and to stay successful. But at the same time, I went to a conference with, our CEO, Vikram, Passive Income MD. And it's one that he goes to with his other company, Limitless MD. And, he had a partnership with Peter Kim for a while. And, he still attends those events. And I went with him this last time. And there was this fascinating debate where almost everyone at this conference are physicians who have been trying to learn how to be better investors, hence Passive Income MD. So the whole conference is based off of passive income. And there was a debate on stage of active versus passive with people that were there who were doing both.
How fun.
And it was enthralling because I'm sitting here and I'm like, obviously like I'm geared towards passive because I'm helping people find passive investments. I'm also very passionate about active real estate. And both sides made incredibly good points. You had one person in there that had 100 LP positions and millions of dollars, and it was clearly very successful and was enjoying not having to do any of the work, had done the hard work of due diligence on sponsors and building good relationships and finding people he could trust. And that was kind of what he was promoting. You had other people that had built 2,000-3,000 units and they just loved active. And they were making the argument that, well, if you hire the right team and you find the right people, you can do this and you still don't have to do as much work. So it really has to do more with your appetite for setting up the structure and wanting to go through the brain damage of property catching on fire or a hurricane coming through or the deferred maintenance of ACs going out and those types of things and the time commitment. But I would say the majority of the people that gravitate towards passive are people that are already working 60 to 70 hours a week minimum. And in many cases, much more, because these are high IQ, high income professionals that are surgeons and they're software executives that are in C-suites. And they're so focused on their thing that they don't have time to research how to properly structure a real estate transaction, or how to protect themselves against risk, or how to evaluate a market and forecast rent growth trends. They're not interested in learning about those things because they're trying to be the best at what they do and where they spend most of their time. And for those people, passive makes an abundance of sense.
Yeah, I totally agree with that. So one of the questions I wrote down, and it's a strategy question. So when you look at what's going on in the economy and in the market, how do macroeconomic factors like inflation, interest rates influence everyone's investment strategy?
Yeah, no, I think this is a great question. And I think it's really relevant now. What you see when you see high inflation, it tends to rise the tide. So when there's high inflation, usually means there's more money. The cost of goods goes up, and that there's certain asset classes that will help you hedge against inflation. That's one of the reasons why I love multifamily, because if everything is going up in price, rents are also going up in price. And if rents are going up in price, then your net operating income is going up in value. And that means the value of the properties are going up. And that's kind of what you saw coming out of COVID. So
like in an extreme.
So like if you were buying real estate coming out of the great financial crisis in 2008, and you owned real estate and you started your company then, and then got to 2020, and you had all of these properties you had been buying, even if you were a small active investor and you were buying 2 or 3 condos a year and you were just renting them out and adding them to your portfolio, you get to 2020 and you have 200 doors. If you exited that portfolio between 2020 and 2022, like, you made a fortune.
Right.
And that was because of incredibly high inflation. So once you go through multiple real estate cycles and you can see what happens on a massive downturn that affects real estate, and then you get to an area that's incredibly inflationary where interest rates are so low that people are hyper levering, using variable rate loans, buying because of how attractive the opportunity is, that is a selling opportunity. And it takes understanding those macroeconomic trends, because if you see rampant inflation and you understand how our government works, you know that the Fed isn't going to let that go unbridled forever. So they will allow inflation to grow. But at a certain point, we have the Federal Reserve that has tools against combating inflation. And what they can do is they basically have a balance sheet where they can buy, bonds, and they also have the federal funds rate. And the federal funds rate was basically grown from virtually zero for quite a while, all the way to 550 basis points. So what that does is that affects the overnight trading rate for banks. And that will matriculate out from the 2-year treasury to the 5-year treasury to the 7 and the 10-year treasury. And the 10-year treasury is what everything correlates to, like for your credit card or your car payment or your mortgage rate. So when that happens, it massively reduces the purchasing power of everyone in the country. And that's what we've noticed since the beginning of 2022 until now. Rates have been so elevated that it's constricted prices. It's constricted people spending. And what Jerome Powell is looking for, and his data to support, that his restrictive policy is going to negatively affect the workforce. So if he is so restrictive that there's less jobs, unemployment arises, then he's saying, okay, well, like, maybe I need to lower the funds rate. If the economy slows to a point where people aren't able to make the money that they're hoping to make, and the economy's not growing and people aren't spending, then what ends up happening is they will use their tools to invigorate the economy. So understanding that ebb and flow is important, because when they make those moves, it's like they're steering a ship. So it's not like if anyone was paying attention to the last few rate cuts, the treasury yields actually went up. So when they make a rate cut, sometimes it can have an immediate effect, but you're really not going to notice the effects for months down the road. And that's why they aren't going to just keep cutting and cutting and cutting and cutting and massive cuts, because you're steering a ship. So you turn that ship and then you have to see where it's going to go. And it's going to essentially go like this. And you're like, oh, I went a little bit too far. I need to like course correct. I need to go this way. I need to see what's going to happen. That's kind of how the Fed operates. Understanding those macro trends and what is going to change the economy from going from a dormant period to a broader successful period is important when you're building in what you're investing in and how you're investing.
Just this week, I put out the blog. I actually wrote it about a week ago, but there's a interesting phenomenon that's occurring due to inflation that's happened basically since, like, we've seen the adjustment happening since 2019, but basically through COVID. And this inflationary period that we've seen has caused an emergence of more accredited investors than we've ever seen. Yeah. And I guess before I go into that, do you want to explain what an accredited investor is?
Yeah, absolutely. So essentially the SEC, the Securities and Exchange Commission, created an accredited investor profile, and they define it as making $200,000 or more as an individual, $300,000 or more as a married couple. Annually for 2 consecutive years. Or you can have a net worth of more than $1 million, not including your primary residence. And the reason that they created this accredited investor profile is because basically their thought process is that if you meet this criteria, then you are most likely sophisticated enough to not be preyed on by groups that are selling you investments.
Right.
So what the SEC tells sponsors like Viking is if you don't want to market your material to the masses and you just want to deal with friends and family or a group of people that you already know, no broad marketing, then you could do a 506B, which will allow you to accept up to 50 unaccredited investors. And then you have to have, above that, you would need them to be accredited. And they're able to self-attest. So the onus really isn't on the sponsor to say, are you accredited? If they say they're accredited, they're accredited. If you are going to operate like Viking does, where we have an Instagram account, we have a Facebook account, we want people to know, we want to help people understand how to invest, and we want really people to understand how Viking works, and we want to have a broad reach. What the SEC makes us do is structure our investment offerings through 506C, which has rules associated with it. And the biggest rule change is not only do all investors have to be accredited, but the onus is on us to make sure that they're accredited. It's no longer a self-attestation rule. So we have to have them work with a CPA to get an accreditation letter, and we have to have that accreditation letter on file in the event that the SEC audits us.
But it's really for the protection of the investor.
And that's the piece. We'll talk to a lot of investors and they're like, oh, well, I have the money, but I don't fit this criteria. Why can't I invest? And, you have to explain to them it's a rule that the SEC puts in because they don't want someone in a nursing home that doesn't really getting preyed on, or someone that really doesn't understand risk. I think, we do a pretty good job as a company because I mandate it with my department that I want everyone that comes into Viking to understand risk and understand what would have to go wrong for them to lose all of their money or for them not to get the returns that they're expected, and talk about how these deals work. But that isn't necessarily how every group is going to operate.
Right. They'd rather kind of pull the wool over your eyes and say, like, everything's going to be just fine no matter what. It doesn't matter what happens in the economy.
I don't think it's always malintent. I just think that one of the things that also came with those Trump tax cuts in 2017 was the ability for groups to syndicate capital. Prior to that, you couldn't. So you might have someone that has the best intentions and they've only been operating since 2016, and they just were like, this is foolproof. Like, I buy this apartment, it goes up in value massively over a couple of years. Inflation's out of control. If we just rinse and repeat and do this over and over again, like, anybody could do this. Like, it's impossible to screw it up. And the reality is that sometimes it is impossible to screw up because of the dynamics.
But sometimes pandemics happen.
But it's real estate, and almost everything in life is cyclical. So
right, but the part that everybody has to know is that no matter what investment it is, there is risk involved. So to not talk about those things would just be silly.
Right. Well, I mean, it really hurts the sales process.
Yeah,
to talk about risk. So I think that's one of the motivations for people not to talk about risk. But
it's like, These white shoes are so wonderful, but you know that they're probably going to get scuffed up the second you
Right.
walk outside,
Yeah.
but still buy them.
When you're at the Nike store, they're not talking about how the shoe's going to fall apart, you know?
Yeah.
But with investment sales, it's a little bit different because to be a successful real estate firm, your goal is to grow people's wealth. And if you can do that in a transparent and trust building way to where people believe and trust you with their hard-earned money, and then you're successful, those people will tend to, especially for tax reasons, roll that money into your next investment.
Right.
Because if they take that money, they're going to be hit with capital gains. So they want to continue growing that investment. And most people are investing in these types of deals to build generational wealth, that they're going to continue rolling it over and rolling it over and rolling it over, and one day hope to give it to their children with a step up in basis. So if you want to be in the game for 20, 30 years, you're not going to get there by misleading investors.
Absolutely. I know we kind of went off on a tangent because it's what you and I always do, but it's okay. I wanted to kind of talk a little bit about what I saw because I think it's really interesting. So the piece is that what you were discussing about an accredited investor. So the specific criteria that you talked about, that was formed in 1983 and has never been adjusted. So back in 1983, there were, I want to say it was like 5% of households in the US that fell into the accreditation status. So in 2022, the SEC put out a report, and there are 24 million households now with accredited investors, which from 2019 was a rise from 8 million.
Yeah.
So I mean, it's like a massive, massive amount of people. And the SEC is saying that this is basically coming from inflation.
Well, yeah, I think it's two things, right? It's A, it's inflation. It's B, broader opportunity to investment. So before 2016, a lot of the kind of syndication space, being able for retail investors to participate in investments, you were pretty much limited to the stock market. The stock market grows on average 7%. It's like 7.5% historically over the last 100 years, 80 years, whatever it is. When you get into a lot of real estate transactions that are 5, 7, 10-year holds, you're looking at 15, 18, 20, 23% IRRs, and you're able to grow your money much quicker. So I think that it's a combination of inflation, wage inflation, where people, there are more people making six figures today than there were 20 years ago. And that money the purchasing power of that money is vastly different. So if you made $500,000 a year in 1985, you felt a lot wealthier than you do today. But you also are able to have access to much greater opportunities to multiply your money as well. And I think that what the SEC has in fact done, they haven't changed the code since the 80s or whatever.
For the criteria, yeah.
But what they did add was a professional services one. So I think that they've actually made it easier to become an accredited investor, because a lot of people felt like what the SEC was doing by having the accreditation rules was keeping the rich rich and not allowing the poor to participate.
That makes sense. I could see where people would feel that way. Yeah.
Right. It's like if I'm not a sophisticated investor, why can't I learn to be one? Why do I have to get there by having an income threshold?
Right.
Like if I have the money to invest and I save my money and I want to invest and I learn how to assess risk, why can't I just take a test and prove that I know the information instead of having $1 million?
So what you're referring to when you're talking about professional accreditation is by profession, like actually being their profession, correct?
If you're the managing director of a real estate private equity firm, but you only make $150,000 a year, it would be silly to expect you not to be able to evaluate risk in a real estate investment.
But also, isn't it if you have an active portfolio of real estate or
not necessarily
are managing it with certain
not necessarily.
hours?
The professional services, which is I think new in the last few years, really has to do with a certain level of education and job title within financial services.
But it's also like the number of hours you put into the specialty and field.
I think it's title, it's position, and it's the type of work that you're doing. If that work would lead to you understanding how to evaluate risk, how investments are structured and all of that, then there are loopholes to where you don't have to meet the income thresholds. And I think eventually what we'll probably land on as people critically think and use common sense is that everyone should learn how investing works. You don't have to be rich to learn how to invest. You might have to be wealthy to have capital to place.
Right.
But I think it's something that should probably be taught in schools.
Oh, I agree. There's a lot of things I think we think should be taught in schools that aren't. The one thing I thought that was super interesting from my research was they were saying if this continues and the SEC doesn't change the criteria, by 2052, over 60%, I want to say it was almost 70, but it's over 60% of households will have accredited investor status based off of the threshold.
That's an amazing statistic.
So I feel like as time keeps on ticking, I imagine they're only going to have one option, which is to maybe change with inflation, just like everything else changes with inflation. But we'll see, I guess, in the next 20 years what happens.
Yeah, no, definitely. It's an interesting thing to think about.
Yeah.
I know when you wrote this article and you told me the numbers, like I was like, wow, I never really thought about it, but it makes a lot of sense.
Yeah. It's a really, really cool thing that I hadn't thought about either. And then when I had seen somebody write a really small snippet on it, I was like, you know what? I need to investigate the situation and really like write something that I feel like will open people's eyes, because it also changes the dynamic for people like syndications, right? Because that opens up how many more people, when we're doing our marketing and we're getting our name out there, like how many people are we reaching that can actually do it? Way more than just 5 years ago. So our company was started just under 10 years ago. We're approaching our 10-year mark. And when we started, we're talking about millions and millions and millions of people who just couldn't access us, who now can, which is like crazy.
Yeah, no. And I think, the resounding majority of those people probably don't understand the advantages of real estate, or that there really is a lot of opportunities.
They may not even know that they are.
Take advantage. Well, and we get this all the time. I train Amir and Amber and Hayden when they're talking to investors. Like one of the very first qualifying questions is, are you accredited? Because we're forced to ask it.
Right.
But that usually results in, what do you mean?
Yeah. What does that mean? Yeah.
So, helping people understand, and, when it comes to marketing, I can't tell you how many people will check no, but then actually be accredited.
Yeah. It's wild. And I think that that's a cool piece too. I hope we bring some enlightenment to people on that, because I can't imagine that everyone knows. I think that the numbers that they pulled were literally just based on people's, who's even reported how much they actually make, their income and or net worth. And that doesn't mean that those people have any idea what kind of benefits they would be able to have by investing.
Yeah, no, 100%.
It's super neat. So my last question for you that I think will be really great is, with everything going on in the economy, what mindset is essential for weathering market downturns like we're seeing and maybe coming out of?
Yeah, I mean, the way that I treat my personal portfolio and the way that I look at the markets in general is I always try to find value. I do it when I go to the supermarket, when I'm looking for a new pair of shoes. Like, I think value is important. So I am very rarely going to buy the most expensive, flashiest thing, whether it's a stock or whether it's a piece of property or whatever it is. I'd really have to want something to pay top dollar for it, because I always feel like there's something out there that is going to provide more value, and it's usually not going to be the obvious thing. So what I would say is, when you look at a run in the market and it's at like an all-time high, like that signals to me that I should be looking elsewhere to find value. When 2021 and 2022 was happening and multifamily was the hottest ticket in town, like, in my opinion, there were probably other asset classes that were much better values. There were definitely segments of multifamily that were much better values. That's when you could look at a B property or a C property that was an intense value add that you were getting at a discount, because everyone was focused on core and core plus and newer value add opportunities. And the opposite is true in a downturn. When there's a downturn in something, if you believe in the fundamentals, this is when you go out and you buy those things that would typically be out of your price range at a discount.
Right. I was actually reading today too that there's, like, from investor sentiment right now, is that some of the big guys are still holding off because they're not 100% sure. They haven't seen enough in sales volume, specifically in multifamily, to say, okay, we are at the bottom. So they're like still waiting it out. But then there's a lot of people like us who are saying, we're going to take advantage of the fact that these big guys aren't being as competitive and bullish, so that we can take these opportunities before they jump back in.
The way that Viking looks at it is that we're able to be more flexible with capital, because we're not using massive institutional capital. And that capital will literally have lines drawn in the sand where it's like, if you don't hit this, then you're not doing it. So there are waiting, but you've seen really big guys like KKR and Blackstone, 300 properties at once for like $1.3 billion at like a 4.6.5 cap rate, which, seems very low given the market, but they save a lot of transaction cost by buying them all together. So there are signals that the dry powder is starting to be put into play, because I think a lot of people are worried about inflation. And when you're worried about inflation, you start gravitating towards asset classes that are hedges against inflation. So what we look for at Viking is, a flight to quality or a flight to safety, because we know once inflation sets in and once interest rates come down a little bit and the Fed gets things under control, and it's not going to go back down to zero, but when it gets back down to what the Federal Reserve calls neutral, which could be 3.5, it could be 4, I don't really know. They don't really know. But once they get to that point, a lot of these gems of properties are going to be out of reach. And in order to buy those properties, you're not going to be able to give investors, or at least our investors, expectation, the return profile they're looking for. And they're going to get gobbled up by REITs that have to pay 7.5% instead of, and our investors are usually looking for mid-teen IRRs and equity multiples around 2 in 3 to 5 years. So if we can't buy that core plus asset and offer that, then we need to stick with A-class properties that are maybe an older vintage, where we can create enough value through a value add plan in order to create those returns. In the meantime, when we can get those really beautiful core assets that institutions are going to be looking to pick up as portfolio plays later on, a really great basis, we're just going to continue to stay in this buying cycle.
Yeah, I love that. Well, as we wrap everything up, I just want to thank you for your time and your expertise. I feel like this was a really wonderful segment. I hope that we helped people maybe look at some new strategies, understand some of the fundamentals of creating a strong investment portfolio. So unless you have anything else, we're just going to wrap it up.
No, just as folks watch these episodes, please do send in questions. I think that, it would be really great to answer some of these lives as one of the segments that we do. And reach out. I love talking about this stuff. Reach out. Let's chat on the phone, talk about investment strategies. I'm happy to help.
Well, thank you again for tuning in, and we appreciate your time. See you next time. Thank you for tuning into this episode. We truly appreciate your support. Don't forget to subscribe, leave us a review, and share the podcast with your friends. Until next time.